Greetings, my name is Christopher Bell. I'm a certified public accountant. In this video, we're going to cover periodic inventory costing. Now, when a business buys and sells inventory, they obviously have to account for it. If they don't, their books are going to be very, very wrong. In this example, we're going to assume that this handsome young man on the left, Christopher Bell, is in the business of buying and selling pencils. Now, Chris is a small operation. He doesn't want to track inventory every second of every day. It's too much work. He's got a lot going on. So he decides to adopt what's called a periodic inventory costing system. All that means is that you count inventory at specific times, once a month, once a year. And throughout the year, or the month or the time period, when you're buying inventory, instead of putting it to the inventory account, you're putting it to an account called the purchases account. And when you go ahead and finally count your inventory, then you close that to cost of goods sold and inventory. Now, this sounds like a bunch of words, right? So let's go ahead and dive into an example. So, like I said, Chris sells pencils. He buys pencils and he sells them. It's one of the most exciting businesses in human history. So on January 1st of this year, he had a beginning pencil inventory of $500. So he says, okay, I'm not going to constantly record cost of goods sold every time I sell a pencil. I'm going to do it at the end of the month. So January 5th, he goes ahead and he purchases $6,000 of pencils. So what is the journal entry? We're using the periodic system. So when we purchase it, we're not debiting inventory and crediting cash or accounts payable. No, we're debiting purchases for $6,000. And we're crediting, we'll just say cash just to keep it simple. We're crediting cash for $6,000. So we have this temporary account on our balance sheet called purchases that will be closed out at the end of the year or the end of the accounting period. Next, Chris sells 500 units of pencils, not dollar amount, units of pencils, so 500 pencils for $10,000. Now, normally when you think of cost of goods sold, you're like, okay, so you do the sale entry, and then you do the expense entry, cost of goods sold, debit, inventory, credit. Not here. This is the periodic method. So what we do is we just say, okay, Chris collected cash of $10,000, and then he made $10,000 of revenue, sales revenue. That's literally all you do because you're not recording cost of goods sold as the sale happens. Now, theoretically, in the matching principle, yes, it should be. But here, we're using the periodic method. We're going to do it at the end of the month, and it's still going to be recorded in the proper accounting period. So now we get to the end of the month, and Chris is like, okay, I don't have anything in my cost of goods sold. What is my cost of goods sold? Well, our ending inventory count, so we go and count the inventory, 1, 2, 3, 4, 5. It shows that we have $800 of inventory, $800 worth of inventory. And trust me, you can get into more detail. You can go FIFO, LIFO, average cost, all that stuff. That's for another video. But we know we have $800 of inventory. So what do we have to do? Well, we began with $500 of inventory, and we now have $800. What's the difference? How much should our inventory go up by? $300. $800 at the end minus $500 at the beginning is how much our inventory went up. So we go ahead, and the first thing we do is we debit inventory for $300. We have to bring inventory up to what it actually is to have correct financial statements. Next, what do we do? Well, this purchases account is a temporary account. It needs to go away, okay? This purchases is just a holding account for inventory and cost of goods sold. Temporary, needs to go bye-bye. So we're going to make it go bye-bye. So we're going to credit purchases, because it's a debit balance, of $6,000. And we're done, right? No. What is the difference here? What are we missing? Well, we're missing a big debit, right? What could that debit be? Cost of goods sold. That's right. Because if you think about it, we began with $500 of inventory, but then we bought a ton of inventory here. We bought 6,000 of pencils here. And then we count at the end and we only have 800. So there's a lot of pencils that are gone, right? Well, that's because we sold them. Or maybe they were stolen, who knows. But we went ahead and sold them. We'll just assume we sold them. And the balancing entry is going to be 5,700. Bada bing, bada boom. See how that works? So most small businesses, And I can tell you, looking at like people's QuickBooks and stuff, this is usually this is the ideal way to do it. Okay, matching a cost of goods sold to every sale transaction, it's a ton of work. But if you're a small business, yeah, just count your inventory at the end of the month. Beginning of the month, inventory, keep track of your inventory. Plug out all your purchases to a purchase account. And then at the end of the month, close it out. That's it. That is the periodic method. You are not recording cost of goods sold until the end of the period. And you just do one massive journal entry to close out the purchases account, plus up your inventory, and the difference goes to cost of goods sold. Hopefully that makes sense. Hopefully you learned something. Stay tuned for other videos. Cheers!